All right, so this is going over the problems that you'll encounter in Module 2. Did not have a similar video like this in Module 1 because Module 1 didn't have these types of math problems. But for all the future modules, you'll probably see a video like this. This first problem is calculating the operating cash flow. I will give you a moment. You can just pause the video and read through the problem there. But they tell us how much we are going to pay in interest, and then we know what the change in our borrowing is, or we can calculate that. And then the interest that we pay on our debt, um, plus this increase from borrowing, would be the cash flow that we have to creditors. Now, ours is negative because we borrowed so much more money, right? So we received money from the creditors instead of paying that. And then for the stockholders, we have the dividends that we pay. So the stockholder will receive the dividends that we pay out. And then they will also either give us money because we are issuing additional stock, um, or the additional paid in will change. This would give us our cash flow to our stockholders. And so everything that does not flow out to our creditors is going to be the stockholder money, right? So when we calculate what is the cash flow from assets, just like with accounting, when you learned about balance sheets, right? What has to balance? Well, it's the assets on one side, and then the liabilities, right? That's what your creditors piece, right? Because that's the money that you owe to the people you borrowed the money from, and then the shareholder equity, right? And then that's where we get our cash flow from the shareholders. So we would have that same balance of cash flow from assets must be equal to the cash flow from creditors and the stockholders. What we're actually seeking is the operation cash flow. So we know what the total cash flow was, um, but we need to figure out how much was money that we made from operations, like whatever our business is. How much did we make from that? And then what is our change in net working capital? So this is going to be the short term asset type thing that we're going to need to operate. And then net capital spending is increases in our capital, right? So taking the equation that you see there, we rearrange it a bit to separate out the operating cash flow so that we can solve that way. This next one is looking at the return on equity. And what we're doing is using what's known as the DuPont formula. We break it up into three pieces: the profit margin, the total asset turnover, and the equity multiplier. So profit margin is how effective you are at turning a profit, or getting net income from some sales revenue, right? So for every dollar I bring in sales revenue in this example, I would keep 11 cents as profit, and everything else has been, the cost of me to get that. The total asset turnover is how effective I am at taking the assets of the firm and turning that into sales, right? Do I have a lot of equipment that just sits there and it doesn't actually make me a lot of money? Or am I a person that's turning over the assets very quickly? And a lot of this is industry uh, dependent, right? So a mining company has just a lot of capital tied up, where a grocery store, their assets, because of that inventory is turning so quickly, it must in a grocery store. So those numbers would be different anyway. But that's what the total asset turnover tells you. And then the equity multiplier is where leverage comes in. So if you have no debt, your equity multiplier would be equal to 1. And what that means is the return on equity would be the same as your return on assets. However, if you have any debt, then your equity multiplier will be greater than 1. And so your return on equity is higher, right? Because you're going to multiply it by a number bigger than 1, right? So this is how leverage results in us getting higher returns, that because it increases that equity multiplier. Okay, and this is just an example of us calculating the net income based on the expenses given. This is probably similar to what you did in Business 209, the accounting course. So this is probably a bit of a review. So if you feel like it seems kind of familiar, it makes sense because this is a lot of what you were doing in accounting. We just want to go through and make sure you're comfortable working with these financial statements, right? The income statement, the balance sheet, and then the statement of cash flows, because we're going to be using those to calculate the financial ratios we need. Okay. Here's another net income um, problem. This one it seems a bit more robust, but we're doing the combination of the last two problems. We're going to use the DuPont formula to suss out, what we need, and then using profit margin and then the known sales, we can then get our net income. So Okay, and then using net income, we're going to work the other way, right, and get to the ROE, return on equity. So remember that's the sort of that end piece on our the DuPont formula we were doing before, right? But this time we're given net income and we're working the other way to ROE. Accounting, again, I'm sure covered current and quick ratios. This is really important when we're thinking of is a firm in a position where they can pay their debts, right? You can have um, plenty of assets, but if you don't have the short term like cash and things that are easy to convert to cash on hand, you can be in a liquidity crisis. So current just looks at current assets and current liabilities. That's why we call it the current ratio. For quick, we pull out the inventory piece. The assumption is that it would be extremely difficult to liquidate inventory for what we're marking it as, like that book value, just because it's very short term. So the quick ratio is going to be a bit lower than the current ratio, but they're both important in us thinking of the liquidity needs of the firm and whether they'd be able to meet those. Here's another ROE question, and a lot of these we're looking at profit and ROE because those are the numbers that we're going to use frequently going forward, right? How much are we turning as a profit, that type of thing. So in this particular problem, the grocery chain is trying to point out that their profit margins are actually low, and this is normally the case with things like grocery stores. And they said if you paid your child $1 to go get $31 worth of groceries, the child would make twice per trip that we do, right? And so basically the profit margin for each the child and the store, given the financials of the store, we can then calculate that yes, indeed, the child does make more, and it looks like about twice, right? Um, and then what is the ROE? So profit margin, is just um, kind of like how you think almost like how much is the markup, right? So for every dollar that came in, the store kept about a penny and a half, right? They're not keeping very much. But how frequently are they doing that, right? Like how many swipes a day are those groceries sliding across? So um using the net income and then the total equity of the firm, we have the assets and the debt. So you could subtract debt from assets, and they'll give you equity. and the net income divided by the equity would give you the ROE of about 5.7. So as an investor, right, you're not getting 1.62%, you're getting 5.78%. That's what your return is. Um, excuse me. Okay, and then this is calculating depreciation. So we are given, the company's sales, the cost of generating those sales, the addition to retained earnings, and then the dividends paid. So we know those combined would it give us net income. We're given the interest expense, and we're told what our tax rate is, right? And so what is our depreciation in this case? And we're basically piecing together from the information, starting with like the bottom of the income statement, with our net income, right? And then we know, okay, if we have this as a net income, before that we would have paid taxes, right? So then how much was taxable income for us to get this final net income, right? And then above that, we would have the EBIT, right? Because we had or earnings before interest and taxes. We just added back taxes. We were told what our interest expense, that 2,850, right, after dividends paid before tax rate. Okay, so you just add that interest back. That gives you EBIT, and we know that EBIT is sales minus the cost minus any depreciation. And so we would just solve for depreciation. So again, these problems are just getting you comfortable working with the financial statements, so that as we go forward, you'll feel confident. And this is one where we're looking at the book value and then market value. So book value is basically what we started with normally, and then we'll have some sort of depreciation, right? And as those depreciate, we mark down the value in the book, right? And then the market value is how much is something selling for today, right? So I can have a piece of equipment and I paid 10 million for it. And over the last 15 years, I may have depreciated this thing down so that it only has a book value of, maybe a few million or two. And then the, if I were to try to sell this in the market though, I might be able to sell it for 7 or 8, right? So that's what we're talking about, that difference in book and the market value. And so you just pause this to read through, but that's what we're doing with this problem. Okay, and now we're looking at a addition to retained earnings. And just remember on your income statement, we start at sales at the top, sales revenue, work our way down to get ultimately net income at the very bottom. Well, you have to do something with that net income, right? You've already paid your creditors because that was your interest payment that came out, right? EBIT minus interest, right? That when you take that interest piece off, then that's you covering your creditors. You pay taxes, right, to cover the government. And then everything left over is the shareholders. You can either take that and give it to the shareholder, that's a dividend, or you can say, we're going to keep this in the firm so that the firm can grow, right? We'll be able to buy new equipment, the things that like that. So that's what we're doing in this one. We're asking what are the retained earnings, given that we're going to calculate our net income, right? And we know part of that is dividends, right? We were told that the dividends was $83,000 cash, right? And then the retained earnings, well, we would add to that to get the net income. And so we're solving for it that way. Okay. And then this problem, it's just to show you, to calculate the balance sheet itself. The total assets must be equal to the total liabilities and the shareholder equity. So the information that was given in your version of the problem, you'll put that in, and then just know that again the total assets has to be equal to that bottom line, total liabilities, and shareholder equity. Right. So when we're trying to figure out some of these pieces in between, we can do it because we know ultimately they have to equal each other. Okay. And this is another one, but this is covering a company over 2 years. So you see 2021 and 2022, right? And then as you see on this particular problem, it also shows the percentages. What percentage of the assets, what percentage of total assets is cash, right? What percentage of total assets is inventory, right? Or if you look further down, what percentage of assets are accounts payable or liabilities are accounts payable? What percentage of liabilities are long-term debt, right? So, yeah, they're asking you to calculate both the dollar value and the percentage. Okay. And then we can use those same types of balance sheets and calculate various ratios, right? So this is again that mining company in 21 and 22. And then obviously just pause it to go through. But calculating the current ratio, remember we did that before, current assets divided by the current liabilities. The quick ratio, you got to take the inventory out of those current assets. The cash ratio is really just using cash, right? This I've heard that referred to also as an acid test. But yeah, that's just if things got really bad, how much cash do they have on hand to settle things, say by the close of the day, that type of thing. And then calculating debt to equity, um, then and then the debt to equity ratio, and then the equity multiplier is 1 plus debt to equity. So just keep that in mind, I guess. If debt was equal to zero, right, it's 1 plus 0, right? And that's why when we were first doing the DuPont formula, I said if you had no debt, your equity multiplier is 1. That's where that 1 is coming from, because we add 1 to that debt to equity ratio. Okay, so there's two growth rates that we normally talk about with our firms, the sustainable growth rate and the internal growth rate. The internal growth rate is how fast you can grow just on your retained earnings, right? So I could stop paying dividends, right? And that would max out my retained earnings. But there's still some maximum value that I can grow if that's all of my investment, right? The sustainable growth rate, what we're doing here is we're saying um, take what you can internally, but also as your firm grows, take out additional debt so that your debt to equity ratio remains fixed over time, right? And that is sustainable because you're able to borrow and maintain that same amount. If you're growing faster than that, the amount that you're borrowing is increasing, right? And there's going to be some limit to how much you can borrow overall, right? And so it's not sustainable if you're doing that. But if as you grow, if 10% of your firm was debt and you double in size and you're still 10% debt, right? That's what we're saying is that sustainable, right? Because you've maintained that same level. If you have the internal growth rate, the amount of debt you have actually is going down over time, right? You're not adding any new debt, and your shareholder equity is growing as the firm grows, right? So it's delevering your firm, right? It's decreasing the amount of debt that you have. And here's a problem looking at the difference between those internal and sustainable growth rates. And the difference, again, like I said, is for the sustainable growth rate, what we're looking at is we're taking on additional debt, right, to keep that um, debt to equity consistent, right? And that's why that sustainable growth rate is going to be higher because I'm able to take out more debt. I have more capital coming into my firm, and therefore I'm able to keep growing. So here's more on that. Right. So again, feel free to pause, or whatever as you are going through this. But it's the same problems, just with slightly different numbers. Um, but that formula of using ROA versus ROE, right? Why is that? Well, the return on assets is how effective you are, right, at getting net income off of your assets, right? And if I multiply that by the equity multiplier, that gives me the return on equity, right? So if your debt rate was already equal to zero, right, ROA is equal to ROE, and then internal and sustainable are the same, right? But if you have any debt at all, your sustainable growth rate is going to be larger than your internal growth rate. Okay, so we're going to look at payables. So we're excuse me. So this is true for any type of payable, right? This is our accounts payable. They tell us how much it is. They tell us what the cost of goods sold is, right? Because that's what we owe money for, is trying to get the stuff that we're going to turn around and sell, right? And then how long does it take for the company to pay off suppliers? All we're going to do is first figure out, well, what's our turnover, right? And so you take the cost of goods sold, the 68,382, divide it by that accounts payable, and we get 5.75 times. What does that mean? That means in a year, I will have completely gone through that amounts payable 5.75 times. So about, it's a little over 2 months, right? Because if it was six, it would be 2 months, right? Um, but it's really close to that, which sounds pretty reasonable, right? If I have like 60-day terms with my suppliers, they give it to me and I have a couple of months to pay them back. I probably would take about that long to pay him back, right? No reason to pay him back early unless they give you a discount. So that's logical, right? But that's the turnover. They're asking us how many days is that turnover? Well, we just use 365 days a year. We know in a year it turns over 5.75 times, and that works out to a little over 63 days, almost 63 and a half. Okay, and this is shareholders' equity. Just keep in mind, shareholders' equity can't be negative. That's the whole thing about limited liability. I can't come after you as an investor and say you have to give more money, right? Because your liability was limited. So, very worst case, it's worth nothing, right? And that's really all we're doing in this one. You're obligated to pay creditors 8,800, right? And we know that after you pay the creditors, what's left over is the shareholder equity piece. So if we made 10,100, we can cover that. It leaves us with 1,300. If we made 7,700, I mean, we're bankrupt, right? We couldn't pay off our creditors. We have no money. But my equity is zero. It's not a negative number, right? Again, limited liability. You don't have the right to come after me. Okay, this is a problem where they gave you the income statement and then they ask you, or income statement balance sheet, and they're asking you to calculate the operating cash flow, the change in net worth capital, cash flow from assets, cash flow to the creditors, cash flow to the stockholders, that all of that. So feel free to pause, look at how maybe your problems that you're working with are different because the numbers can change. And feel free, of course, to jump back and forth in the video. But this next slide, I'll show you the how to work through each of those pieces. So calculating operating cash flow, calculating change in net working capital or net capital spending. And then we had the cash flow that we've done already, cash flow from the assets we've calculated. And then we know cash flow to the creditors and to the equity holders. So we can calculate those pieces. And then in our particular case, again, we have a negative cash flow to stockholders. That's because while we did pay dividends, we also have this new equity piece. So here's one with income tax. I've taken table 2.3 and stuck it there on the right hand side. And the just to have everything in one place, right? And so these are marginal tax rates, and you notice as you're making more and more money, the tax rate itself is going up. This is normally how income taxes work in the United States. When we're calculating our income taxes, you only pay that tax rate in that band. So for $9,950, we pay 10%. And then you would take the 40,525, subtract off that 9,950. That amount gets taxed at 12%, right? And then when you make another dollar, you go to the next bracket. So starting with the next dollar, you're paying at 22, all the way up to 86,375. The next dollar you make again kicks you into the 24 bracket, so on and so forth. So in our case, we have a taxable income of almost 200,000. So we're going to be in that 32% bucket, right? Um, and that's that marginal tax rate. The marginal is when you what is your next dollar being taxed at, right? Um, but the average tax rate you pay is an average between 10% to begin with, then 12%, then 22, then 24, and then 32 for the last 35,000 or so. Um, we calculate the total taxes paid, total taxes divided by total income. That would be your average tax rate, right? But the marginal tax rate is what we are often thinking about with decisions, because if I work one more hour, when I earn that additional money, it is being taxed at 32%, not at that average of 22. Okay, and we'll wrap up with one more networking capital problem. We're told what our current assets and current liabilities are for 2 different years. And they're just asking, okay, how much did it change? That's right. So, it's uh, the change is just what was the ending value minus what I began with, right? That's necessarily the change. And then I just calculate net working capital, both this current year and then the year prior. And that's how I solve for that. All right, that's it for module 2. Like I said, you'll see like module 3, 4, 5, 6, 7, 8. And you can use those to help you as you're going through these assignments.